We all had a good weekend. We got a pretty light schedule for today. There's going to be some Fed speakers, and the president is going to be on a call, but not much more other than that. We do have the CFNAI, Chicago Fed Activity Index. A really good understanding of the market comes from understanding a lot of these economic events. Most of us don't have an economics degree. I usually refer to it as basic basement economics. If you have a base economics understanding, then you have a stronger understanding of what's going on in the overall market. It's not something you have to go out and learn all of it all at once. You just kind of do a little bit at a time, and you would be surprised at how much more insight you have into the market when you understand what these reports are focused on and what they're trying to tell you. Thinkorswim provides these descriptions, but they don't write them. These descriptions come from a website called Econoday. So if you want to understand more about what's going on, that's a really good place to start. It's free. It provides a real good detailed description of what it is. And then it usually has something like why you should care, right? And I really like that because it kind of sinks home everything that was in the report. And then, of course, you can always just hit Google or YouTube and type that in and just take it one at a time. Maybe pick one a week. It won't take long before you've got a really strong understanding of most of these economic indicators, including when they are revised and manipulated, kind of getting a little bit of an understanding on that background as well. We do have additional auctions today at 11:30. That is really important. I know they're not the sexy, glamorous things like job numbers, things like that. They don't get the headlines that these others do. But I trade with my eye on the clock, and I can tell you many times right at 11:30 or right at 1 o'clock when we have these additional auctions, you can witness an extraordinary change in the market, going from a range bound market to suddenly trending, or having a great, beautiful trending day, just suddenly stall and not do anything else for the rest of the day. So today we've got additional auctions at 11:30, and that's it. That and some Fed speakers. Now, where they speak is important. We were kind of talking about this last week. If you see that there's going to be a Fed speaker and you find out that they're having lunch at the Girl Scouts of America and that they're going to have a talk, you're pretty safe to assume they're not going to be really slamming down on their thoughts and opinions on economic policy and presenting rate hike suggestions and all of that. I'm not going to say that it can't happen. We know that it can. I've certainly felt the effects of a non-voting member at a just regular lunch get asked by a reporter a particular question about interest rates, and his off the cuff answer was misunderstood by that reporter, and it dropped the market considerably. So it can happen. It's just not very likely to happen. Most of the time, things are fine, right? But you still want to know who's speaking, where they're speaking at, what they're supposed to be talking about, and the big one, will there be Q&A? Because if they just get up at Girl Scouts of America and give a 90-minute talk and they duck out the back door and don't talk to reporters, they're not going to move the market. They get done talking and start answering questions for 30 minutes or an hour, they have the capacity to screw up, to open their mouth and put their big old foot in it and, really rock this marketplace. So a little bit of perspective, right? There is an argument right now about the marketplace. Is this a bear market rally or a dead cat bounce? Is this just a pullback before rolling over and continuing that move to the downside? Is this a rally to the upside? Right. So historically, there is a thing called a bear market rally. It's worth looking into. You'll learn quite a bit about how uh, technicians and chart nerds quantify the data and look at historically when we're in a bear market, which we are 100%, we are in a technical bear market. When we start to rally out of that bear market, there is a sea change across the board, right? So right now we've got a really strong push, a really clean rally to the upside, higher than just a dead cat bounce, but it still could be what they call a bear market rally. And then historically, a bear market rally is about a 10% rally. Some have been known to go 18. There was even one or two that hit 20. We're at 8% off of the low. If you count, where we closed Friday, 10 is typical. So we're getting kind of close to having an answer on that. This is the 50 and the 200. We're on a daily chart, and you can see that the 50 crossed the 200. Now, technically speaking, this generally is a very bearish signal, but historically, if you go back and look at how many times this has happened in the S&P and then what happened afterwards, this is almost a contrarian indicator that it and like puts out the siren, and this becomes the buy signal. Very interesting when it comes back to the nerd side of the marketplace and running quant data rather than just trading on what we think or how we feel, right? Because nobody gives a damn what you think. You don't give a damn what you think. You want to trade what you know, not what you think. We're still underneath the 200, but we are back above the 50. Being back above the 50 triggers a lot of oh, we got to put it in a context that makes sense. The institutions don't have the freedom that you and I do. They don't have the permission to just go out and trade because they think it's a bottom, right? Because they're not allowed to trade what they think. They have to trade very specific signals. So when we were along the lows, if they thought that that was a buying opportunity, they couldn't buy it. And of course, when we say they, there are a lot of them, and we can't lump all of them in the same group, right? There are different funds out there, and those different funds have different rules about how they can allocate capital, where they allocate that capital, when they have to sit on the sidelines. It's all kinds of risk metrics that have to be applied. Getting back above the 50 is one of those risk metrics. So when we can see more participation from the institutional side, just because we've accomplished a technical trigger, that's going to really help out. There's a checklist on calling the bottoms, and I was going through over the weekend looking at the list. Basically, everything has been checked off the list, but there's still the war, and the war doesn't care about technical analysis. Peace talks kind of fell apart again. So there is opportunities to trade where you can use like an either or trade, something like a back ratio combined with a wrist twist spread or just a broken wing butterfly. Those allow you to go long or short, pick your direction. And if you're wrong and it goes the other direction, you don't get hurt. You don't make any money, you just don't lose any money. Now, that may sound like a really great trade because if it goes up, you make money. If it goes down, you don't. Or if it goes down, you make money. If it goes up, you don't. But you don't get hurt when you're wrong. It almost sounds too good to be true. What's the catch? Well, the catch is if we stay sideways in the spot, right in the middle where you built that trade, that's where you get hurt. So those either or trades are really good. Something like a gamma iron, say buying an iron rather than selling the iron. When you sell an iron condor, you put price inside of a box and you're basically saying, I bet you don't leave the box. Well, instead of selling it, which is the most popular trade out there when it comes to iron condors, most people sell them. But if you didn't sell it and you instead bought it, then you're basically making a play that says, I bet you will get out of this box. So, of course, if it gets out of the box, upside or downside, you profit. That's an either or trade. But if it stays in the middle, you're going to get whacked. All right. So, you don't want to put one on if you think that we're going to lag or stall or hang out in a particular area for a long period of time. All right. So, we're looking at the S&P. We had a question yesterday in the general chat, and it was the age-old question, the day trader's dilemma. How do I know before the market opens if it's going to be a choppy day or not? Because I try to trade in the middle of the day and it turns out that I'm trading in a choppy market and all I do is get chewed up and I don't know that it's a bad market until after I've already been chewed up and I give up after making a bunch of trades that lose. If you are in that boat, if you can't recognize is today a choppy market, is it likely to be a range bound market? Am I going to get chewed apart? You can ask a simple, very, very simple question. Are we inside of our own Globex range? The follow-up question yesterday when I presented this discussion is what's Globex? If you're a day trader, you absolutely better understand what Globex is. Depending on your broker, it may not be so easy to see as this, but anything that is not inside the regular trading hours, the RTH, anything but outside of 9:30 to 4, that's Globex. Now, if somebody presents you information and you choose to ignore it, because I've seen people turn it off. They turn off their Globex. Oh, I don't need it. I just turn it off. You're ignoring information. You're ignoring a lot of information. If we're inside of our own Globex range, you're very likely going to see a choppy day. So nice, simple, and easy. You can just draw a box, throw it across the day. If price stays inside that range, it's very likely going to be a choppy day. Use your broker tools, set an alert on either edge of that thing, and go do something else. Now, I'm not saying that you can't trade here. You absolutely can trade there. But if you don't have the skill to trade a tightly compressed market like that, because it's a difficult thing to do, then quit doing the difficult stuff, leave it alone, go make cookies, go trade a different market, do the easy stuff. If we consider that to be zone one, then the next zone would be just expanding that question a little more and saying, are we inside of yesterday's price action? Because if we are inside of yesterday's price action, it's very likely going to be a choppy day. Now, I'm going to put a little asterisk on that statement and say if the previous day was a very large, wide ranging day, say like Friday, where we moved considerably from a low to a high, there is plenty of room today to be inside of yesterday's price action and still have good, clean trading. But generally speaking, if yesterday was kind of narrow and then we are sitting inside of yesterday's price action, you're very likely going to have a choppy day. It doesn't mean you can't trade it. It doesn't mean that you shouldn't trade it. I'm just pointing out if you're getting your butt kicked in the daytime because you can't recognize if today is going to be choppy or not, draw a line, connect it to yesterday's prices, and ask the question, are we still in that range? Yep, probably going to be a choppy day. You don't have the skill for it, go do something else, go trade something else, save your money. It's that easy. So for today, we've got our eye on the high of yesterday. We made a significant move off of those lows. There is still plenty of market left to go. Should we continue to see that burn to the upside, it wouldn't be much of a surprise, but we are starting to get to the edges of what would be considered too far, too fast. Linear regression, mean reversion, dot plot statistics say that we can't move that far that fast without repercussions. Think about pulling a rubber band back. The more you stretch it, the faster it's going to come back in the other direction. Every market has a measured move from a 1 minute chart to a 1 hour chart to a daily chart, weekly chart, monthly chart. There is an expected move for every market at any point in time, always. Always. So when the market begins to move beyond that expected move, it's a very simple thing to be able to point out that we are moving into an extreme, that we are beyond the edges of a one standard deviation in price. If staying inside the box is what we do 70% of the time, when we get out of the box, then we're doing something that we normally would only do 30% of the time. Obviously, that means we're doing something unusual. This is the range for the week, 45.62 to 43.62. I'll just move that down 5 points so we got easy numbers. It's a 200-point range in the S&P marketplace. Oddly enough, it's a smaller range than last week. They say the volatility is decreasing. Should we break above today's range, then 4,500 is the target. So we want to look at the institutional pivot points or universal pivot points from yesterday. One of those pivot points is yesterday's high. One of them is yesterday's low, the open and the close. Well, the high and the close are really close together. If you want to mark exactly where that close is at, you can go out to your daily chart and mark it from there. And the reason I suggest that is because there's different close. And I know that that may sound a little confusing, but there's the 4 o'clock close, there's the 5 o'clock close, and there's even a 4:15 close in some cases. And then, for equities, there's like the 7 o'clock, right? There's the after hours in equities. So, which one of those closes should you use? And just go to the daily chart and mark the close from there. Whatever the broker is signaling here as the close, that's good enough. There's your close. Then you don't have to worry about it. You don't have to fuss about it. If you're looking at the futures, where we open in Globex is important. All right. So you look at Sunday night, 6 o'clock, Where did we open? Well, we opened, gapped down, and then we rallied right back up again. So 44.60 is the Sunday open. There's very likely going to be a reaction when we get to it. We already got to it. You missed it. At this point, we need to get above it, challenge yesterday's high, and then 45.00 will be our upside target. If this remains muted or we see that lack of participation, then we're going to start targeting our own Globex low, 44.30, the COG line at 44.11, yesterday's open, 43.70. Now, there is a 200 period moving average down there on a 15-minute chart. There is the 4,400. So there are some values where we could find support, and we'll validate all of those by using a volume profile. It's easy enough to just draw some lines and say, oh, look, there was a pivot point back there. Yeah, okay. But when you can connect that to some volume on the volume profile, or a point of control, or a value area high or value area low, then you've got more validity to the line than just, oh, well, there was a pivot point back there. Yeah, okay. So we are in volume resistance, 44.60 to 44.45. That whole area is a volume resistance area. If we happen to drop below 44.45, we got a shallow area that gets us down to around 4,400. We can expect to see some volume support underneath that level, 43.90, 43.80 area. If we widen the scope out off of that 30-minute chart and put it on a 1-hour chart, you can see that we're just getting out of the top of the range that we've been holding for a few weeks. Think of this as the opportunity to see a really, really big Busby. If 4,400 is the top of that resistance zone, and we finally have broken through the 4,400, if we're expecting a Busby, then this would be the opportunity to see the market come back down, validate the old resistance as the new support. It would imply that we're expecting it, that it's what we would expect to see at any other point in time. There's also the idea of the current trend. If you think about the swing high and the swing low, then you've got that persistent pattern above and below the linear regression line. And we've just completed the lower edge of that swing. So this is the chance for the market to continue the swing high, swing low, or to fail here and give us the Busby. One signal that we're not going to complete this swing high, swing low pattern is if we reject off of yesterday's high. If we reject there, fail to set a new high, then it's very likely we're going to go back down to 4,400 and validate that level. That wouldn't make us bearish, right? Keep in mind that would not be bearish as long as we're holding above the box. Then that would not be bearish at all. So we can get back down to 4,400. We could even drop a little bit lower than that, say 44.75, or excuse me, 43.75. But if we get below 43.75, then we're going to start being bearish again. And this will no longer be considered, a rally up off of the off of the lows and everything that we've been talking about. For the Nasdaq, tangled in the 50, not above it yet. And by the way, you can plot those daily indicators on your intraday chart just using an indicator that comes on Thinkorswim. Just type in the word daily and you'll see daily SMA. If you want the EMA version, there's one in the Discord. You can just go and get that downloaded, right? Get it imported in. I like the SMA. It's what I use generally, but you know, there's no wrong one, no right or wrong way to go. But if you want to see those on your intraday chart, and it works for any time frame, by the way. I know it has the word daily in it, but if you wanted to, be on a 5-minute chart and see where the 15-minute EMA or SMA is, that'll still do the job. So now that orange line right there is representing the 50-period daily moving average. You can see that we hit it on Friday, we pulled back, and we're attempting to get through it right now. Knowing that it's there really provides a lot of value, right? Knowing that we're going to hit something, that we're moving towards something or away from something. You can see that the box for this week is smaller than the box from last week. This is implying that implied volatility is smaller, is less, it's decreasing. So we're going to be looking for any signals this week that this is just a bear market rally. Literally, that's a thing. Just go search it, you'll see. So we're asking the question, is this a bear market rally? Are we done? Are we coming back up? We're going to revisit those lows again. A lot of that's going to be directly connected to the war and any news out of the war. Anything to do with the peace talks, uh, an escalation of the war. I'm still going to continue to tell people proceed with caution. There's one or two situations that could cripple this market and see it just completely crash and burn. And one of those situations would be if the UN joins in the fight, because that would then bring all of us in, right? Well, Russia over the weekend said that any supply chain that they find that is transporting war material, meaning it's not food, it's not water, but it's military transport from anywhere in the world coming into the Ukraine, they're going to consider that fair game and they're going to attack it. Well, if they kill a United States soldier, that would give the United States the opportunity to escalate the war. Doesn't mean we automatically will, but if we're looking for an excuse, that would be one. Any hacking of the European alliance or any hacking of the NATO alliance that can be 100% presented as being a Russia hack, knocking out somebody's infrastructure grid, something like that. Those kind of situations will send this market down worse than anything COVID did. You won't see it coming. It won't be anything in the candles that you would be able to see. No amount of technical analysis would prepare you for that. So, as much as you want to take opportunities in the names that we would look at, just always keep that in mind. We had a pretty decent run in oil last night. It's kind of topping out, slowing down a little bit. I want to keep our eye on that. The dollar and the VIX were starting to correlate a little bit, but it looks like they finally decoupled. I want to keep our eye on that, make sure they don't start to sync back up again. We're starting to see a little bit of a move where stocks and bonds are moving together. Keep our eye on this to see if it's going to separate and decouple. And Bitcoin kind of just toeing the line, holding its level, trying to get this gap closed. It's important that we keep our eye on these. So we're looking at the overall marketplace, trying to put all the pieces together when we see the S&P breakout or we see the NASDAQ breakout, that we want to be able to validate that move and confirm it by looking at the FANG names plus T, by looking at the bonds, cumulative tick, right? All the things we continue to go through every day when we're going through what's moving the market, what sectors are moving, what names are in those sectors. The dollar opens at 8, bonds open at 8.20. And they can give you a little bit of insight. On Monday mornings, the market has to price in all of the news from the weekend. Now, sometimes that can take 5 minutes, and sometimes it can take the entire morning. So, on any day, you would want to go back and evaluate, is my bullish bias still solid, or is my bearish bias still solid? But on Monday, you definitely want to circle back. 9:45, 10 o'clock, 10:15. It takes moments. Once you kind of get into the groove of checking these things, you can check them really quick. It doesn't matter what you're trading, right? It doesn't matter if you're trading the futures or Apple or Tesla. It doesn't matter. Because what's going on in the overall market is going to knock your market for a loop unless your market's directly connected to a news event, say like Boeing. There was an airline that went down in China, and this is the result. Now, it is pretty safe to say that no matter what happens in the NASDAQ and the S&P today, it's not going to affect Boeing. Boeing is completely decoupled from its own sector, its industry, and the marketplace, and is only connected to that crash. So unless the thing that you're trading has its own news making it move, then it's going to stay coupled with its peers, its sector, its industry, blah, 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 right? Now, Thinkorswim doesn't do a good job of showing us pre-market change percent. One of the reasons that I like having TradingView, TrendSpider, both of those will present change percent a lot better than Thinkorswim will in the morning. It doesn't mean that we can't find something, because of course we can modify our own indicators, our own watch lists. One of the things on the move this morning is energy. This is XOP. You can see that beautiful gap up after consolidating Friday. That was XOP, but now we've got XLE, also gapped up, but a bit weaker. And minerals and mining. Those three usually tightly correlated. Also gapped up, but look at the lack of volume here. They're just dashes or marks. So we're not seeing a lot of flow in that. Values up going into the close on Friday. Emerging markets is one of the names that we look for global participation. What happens in the overseas markets? Where's the overseas money at? In a risk on environment, when we're bullish in the morning, we see the EEM to the upside. And when the global markets are bearish, we see it to the downside. Another one you can look at is junk, JNK. If we're bullish, coming into the market, then we expect to see this bid up. In a risk on environment, we would expect that to be bid up, right? And we're not, it's bid down. Risk on is no longer on the table. The only two sectors that we need for a bullish rally is the XLF or the XLK. Now, either one of those can do the job to a point. It would be a muted rally, but it'd still be a rally. When you have both of those sectors, that's when you really start to see some fire. When you combine that with the FANG names, you get a really good idea of what's going on in the market. You got your pulse on the entire marketplace with a perspective of what's going on out there. Now, those 11 legacy sectors of the S&P, they're old school, they're outdated, and they really don't give us a perspective of the modern world that we live in. We need more sectors. Well, one of the things that you can do is you can create your own little homemade ETF or your own little homemade sector, so that if we want to, say, look at electric vehicles, there's not a really good electric vehicles ETF that we would want to use that would represent that sector in a single name. But if we were to gather up a lot of the EV names out there and then look at all of them collectively, we got a pretty good idea of what's going on in the EV market on a day-to-day basis. So for an example, this morning we can see that XOS is up over 2%. Tesla's up over 1.5%. Then you got Lucid, Ford, NIO, Ride, General Motors. Now, General Motors is down a significant amount. You want to find out, if you're looking for an opportunity to trade, why is this down against all of its peers that are up? Or, X Auto or XPEV and Li Auto. Why are they down when their peers are up? Which group is wrong and which group is likely to catch up with the other group? The ones that are down rallying up to be with their peers, or the ones that are up falling off to be with their peers? There are a few times where you'll see the legacy names like GM and Ford kind of decouple from the rest of its peer group, but usually that's connected to news that is readily available all over the place, and it would be a pretty obvious situation. Another sector is the pot stocks. The S&P just really doesn't do a good job presenting a sector like pot stocks, right? We don't have that old school legacy. Now, the sky's the limit on the different ways you can put all these together. But the pot stocks are looking really good this morning. While it sticks, could be a nice opportunity to short these suckers if they begin to roll over. Some of these names are up a considerable amount. And crypto. The old school S&P sectors really do a horrible job of presenting that. Now, this crypto list came from the Smalls Exchange, because over there you can trade their new crypto product, and they have a database of what is in that product, what the names are, how the names are weighed, And that's where the names on this list comes from. On a day like this, with everything so muted and really not presenting an opportunity, we're very likely going to want to back away from the sectors and use our own individual watch lists to find opportunities to trade. Think of it like a really big funnel. We're trying to weed out over 600 names and bring that down to 3, maybe 4 really good trade opportunities as we come into the open. That number 600 wasn't random. That's how many names we have that have weekly options. And just because it has weekly options does not mean that it's liquid. But a company earns the right to have weekly options through liquidity. So it had to be liquid enough to get weekly options or it wouldn't have it. So that's a good starting place. The other list that we've been doing, since this is such a big list, 600 names, if you try to do that on Thinkorswim, you'll get errors. You start adding watch list columns to a watch list with 600 names, you kind of break it. So we started using the CBOE website and looking at last month's most heavily traded products, options products, and then using that list. We get a much smaller list that way, right? And we know that it's the most heavily traded products. So they're going to be the kind of the best of the best. The list resets every month. Kind of looking at it this morning, it's a pretty good list. It's really diverse. It's got all the different sectors in it, all the different industries. So we can see those FANG names are in there, but there's actually a better way to get a perspective of those FANG names. Bring in something like TradingView. Now, Thinkorswim, you can do the same thing on Thinkorswim after the open. But what we're about to do, you can't do on Thinkorswim until you get the open because it won't present the pre-market data. Come on, TradingView. So Thinkorswim has this heat map, but again, it won't show pre-market change because Thinkorswim just doesn't really do a good job at pre-market change. So we're looking at the S&P 500. We set it to pre-market. We adjust the filter. We don't need 500 names. We want to try to get this around 100 names. 93 is close enough. And right now it's using whole numbers to change the color scheme from red and green. We want to dial that in a little bit and use percentage decimal numbers. So now we got a clearer picture of what's going on out there this morning. You can see that Tesla's up 1.5%. We've still got plenty of time to see this market kind of slow down. And there is a big disconnect in half of those EV names this morning. So either they're going to catch up with Tesla or Tesla's going to fall down to them. Looking at the other FANG names, we're mostly flat. Apple, Google, Microsoft, Facebook, Nvidia. There is a little bit of bid up market out there, not a whole lot, right? Now the S&P has financials in it. The NASDAQ 100 does not. We don't need to adjust the number of names shown. It's only 100 names. We're already on pre-market change. We just want to adjust the color scheme. Looking really negative out there. Couple of names that stand out, right? Tesla, Nvidia, AMD, Team, Inuit Software. There's a couple of names. But for the most part, we're either slightly flat, slightly positive, or a considerable amount of names to the downside. Now, we don't have to guess or assume, well, how many names are down, because we can run the numbers. So how many names in the NASDAQ are down at least a half of a percent, and what sector or industry do they belong to? Technology services makes sense. It's the NASDAQ, but a couple of retail, manufacturing. How many names are down at least 1%? 5. It's not too bad. One of those names is Lucid. So back to the EV market. But overall, not too bad. Do the same thing with the S&P. We'll start with 1%. General Electric and Boeing, no surprise there. And the S&P down a half of a percent. Start bringing in Honeywell, Eli Lilly, and Disney this morning. So Disney is a great representation of streaming services. You see Disney moving around, you automatically want to start checking out its peers. And what we're trying to do is get a feel for the names that are going to be opening. It's not one individual name, right? When you're coming into the open, you want to already have a feel for the industry and the sectors that are moving the markets, because they're what's going to move the market. One name by itself, you've got to connect it to news. You've got to connect it to its industry or its peer group and find out, why is that one name moving? Boeing, for an example, is not moving with its peers. It's not moving with its sector. It's not moving with its index. It's moving because of the news this morning. So unless every single thing that you're going to trade is connected to some news source and is moving on its own, then anything that you're going to trade this morning is going to be connected to the sector, the industry, the index. Last week, we had a correlated market state. 84 names out of 100 were moving to the upside in the NASDAQ. You didn't have to go in and try to pick a name. They were all moving. On Friday, for an example, in the S&P, 352 names were moving to the upside. There's only 500 names. So when 85 or 90% of all the names out there are moving to the upside, you can get a lot more particular about which ones you want. The higher beta names, the ones that are going to make the bigger move. It's still going to come back to the two risk on sectors, the XLF and the XLK. So keep your eye on the sectors. Watch the cumulative tick, cumulative market breadth. At the moment, we're going to want to see the bonds disconnect from the stocks, because we've got stocks and bonds moving in the same direction and the VIX is not responding at all. And I will see you guys in the live stream. Start at 9:15 in the futures room.